Hi, this is Randy Finney with Right Side of the Chart. This is a closing market wrap for the week ending Friday, March 6, 2020. We'll start out here with some of my trend indicators. I did share these within the last week or so, and I've over the years covered these many times. Up top, I know you probably can't see it here in the video. I'm not going to get into it too deep because we don't have any change yet. These are my longest term trend indicators up here, starting with a monthly chart using various trend indicators. Again, covered in recent videos, so I'm not going to go through them all here because we still have these on buy signals, or at least a bullish, we'll call it more of a bullish trend. I wouldn't necessarily call it a buy signal, but their still trend is bullish. And that is, again, on my SPY monthly chart, several different indicators there, in addition to the that 20-month EMA that I use. That's not on this one. And my weekly trend indicator, which has a pair of 14 and 17 period moving averages, and that's still bullish too. So we're going to start down here. I'll zoom in where you can see this one. This is the what I call my daily intermediate term trend indicator. One of them, there's different ones I use here. Let's punch it down here a little bit. There you go. And what you're looking at here is simply a pair of moving averages, and they're pretty key moving averages a lot of people watch, the 50 period and the 20 period exponential moving average, again on the daily charts. And what you have, you call it well, actually, anytime you have a pair of moving averages and you're using those for trend purposes, a cross of the fast moving average up above the slower moving average, like you had right here, for example, the 20 is this green line, the red line is the 50. That's called a golden cross, and that's bullish. And then when you have a cross of the 50 down below the 20, it's called a death cross, and it's bearish. Now, these prove to be somewhat whipsaw signals, and what I've done down here is I just created a custom indicator. I've shared this many times in the past as well. If you're new to the site, let me know and I'll show you how to create that. Just drop me a comment, or put a comment in the comment section below this post. So you could call these whipsaw signals, but again, they came in periods where there was more downside. So not really a complete whipsaw. We just haven't had any large trend changes for a while here. That one certainly will call that a whipsaw. Very slight, they kissed. But for the most part, I'm going to roll back here in time, and you can see on here that it's done a pretty good job going back for years of defining bullish and bearish trends. Again, I've gone back now for several years, and you can see, pretty much this point in time, it said the trend was bearish, and it was. We had a buy signal, trend was bullish for a while, and then again the trend was bearish. And for the most part, remember, we've been in a bull market, so you do have these little corrections along the way. But when you go back, roll back far enough, we'd have to do it on a different chart. I can only go back here to 2014 right now on this one. It does capture the bulk of the bearish trends, and here's a good example. 2014, 2015, look at that. That was a bear market in many indexes, such as the small caps, in many sectors. The SPY, S&P 500 just barely avoided missing that designation of a 20% drop, but call it what you want, it was certainly one of the most powerful corrections within this entire bull market we've been in for a while. So there it is. And so again, sometimes you get these little one and done blips, and sometimes that trend indicator, when it flips, is a relatively early sign that the trend has changed. And I've gone over that recently. We had a death cross, they call it, when you cross the fast moving average crosses down over the slower moving average, in this case the 20 down over the 50. So that happened already back here, again as pointed out on February 28th, and that trend indicator is solidly right now on a sell signal, that one on the SPY. However, when we go to QQQ, it's not. The Qs have been the leading index throughout the entire bull market, and they were certainly, went up quite a bit higher on this latest run up, and so they're just hanging in there. I just wanted to point that out, that a lot of times these lines will come down and kiss each other, and then keep the trend intact. You don't see it here, but going back in time, there's a kiss right there, and that's where we're at now. Often when you have this kind of momentum, when you have the 20 coming down fast onto the 50 like this, you're going to cross. You just have that downside momentum going, so it does look like a bearish cross is impending, but it hasn't happened yet. And if and when it does, and we start to get some deep red indicators, that'll be something to look at. It'll tell us, hey, this intermediate term trend has changed, and then we'll be on a lookout for a change back to bullish to gain the first counter trend, decent lasting counter trend rally. And we just had one, of course, in the market up until yesterday, up to the Powell pop on Tuesday. Technically that was a high, and we got in there on Friday on an official QQQ long trade, milked up almost all of that bounce, got out early, but right, not too far short of where the market stopped. So, and of course now we're in short, and so we'll use this in conjunction with. I don't trade solely off these trend indicators. I like to use them in conjunction with other buy and sell signals, trend line support breaks, trend line in price resistance and support, but I did want to go over that. And I can also tell you that all of my short-term trend indicators right now, like this one here, are clearly bearish, so there's no reason to even talk about it. I think it's pretty clear, and I made that clear. The short-term trend is bearish. Okay, let's move on and see what happened today. Let's look at a couple other charts, and we'll wrap this up and let you get to your weekend. Okay, to recap today, probably the best place to start is where we started out this morning. The first post of the day I did before pre-market, about an hour and a half. This screenshot was taken a little after 8 a.m. and that was a post titled, "Powell's Folly Brings Stock Futures Down to Next Support." And so we'll start out here, and this proved to be the levels today that really came into play. Here, I'm gonna zoom in tight. This is NQ first, and of course at that point in time I had mentioned where my my thoughts were in my positioning. I said I did take a shot to go long there and rallied up here. So we were at that key 83.57-ish support right there on QQQ. And we had a first target up here, like I said, a target that a level, it's an important level. If we took it out 85.06 rounded off, then that would most likely open the door for more selling. Otherwise, we're going to jog down. Now we kind of did a hybrid of this. We did this, we went up, we reversed there. I'm going to get to the updated charts in a second. Well, let's do that now. And there it is. So this is the same chart from this morning, although I did add on the updated post to this afternoon. We have essentially divergence, almost flat, about equal lows there, close enough, and higher lows on the PPO down here in RSI. That's positive divergence. And so this is where we were this morning. And at the same time I posted that on NQ, the NQ was at that 83.71 support. Let me go back to that post. Okay, that threw me. It was what I had posted. The one gripe I have about this charting program is every time I try to measure, draw trend lines, if you come too close, you try to grab this trend line, you grab that one, it moves it. So I had this at 83.50, what was it, 83.56? I think it was coming off right around. I was looking at this there, that was the line, and it was 83.55 or 6. So disregard what you just saw. Again, I'll go off this one this morning, 83.57 or so, this reaction low here and that. So once in a while those lines get moved. If it confuses you, it confuses me as well, but I caught that one. All right, that's it. So we had it bouncing up there. Back to what happened. Let's just look at today. And that was it. We played ping pong really between that support level, and we tested it this morning. Remember, we went a little bit lower because at the same time that I posted that this morning, I included also a chart of ES showing you that while NQ, didn't mean to click it again, while NQ was at its comparable support level, we had ES, same support level or comparable level. See, this is the ES chart. There was that same reaction low and all those other reactions. I see a lot of, just my mind's eye, that's what I see a lot of candlestick tails and or bodies right there on that level. And so that's what stood out to me. So that was about the 2900 level. So in other words, ES had a little more downside to hit that, and that's what happened. And again, it was almost to be expected. One or the two would reverse there, and it turned out, and we look at ES, that's it, almost to the button. So you see we came down this morning, right after, shortly after that post. That chart was screenshotted in the morning. Came down, we hit it, we bounced up there. Here's that 29.75 level, and here's that 29.51 level, 29.52 right there. And so we bounced up, hit that, came back down, hit it again, hit it again, all the while putting in a divergent low right there. And that's what I posted a little bit before the close to give you guys a heads up that we had a divergent low, and then we held that low. So what you're looking at today, in a nutshell, is two successful defenses of the 2900 level. So whereas earlier today I mentioned it as a minor support level, it's a little bit more significant now because you've had multiple reactions. Even though it's 3 candlesticks, and you can call it 3 tests, but anytime you have a cluster of candles, even if you had a third 60-minute candle here, I'd say that's one distinct test with a bounce and another test, even though it's multiple candles. So call it what you want, but it is 3 more reactions there. And then at the end of the day, as I pointed out, we put in a bullish engulfing candlestick. And what a bullish engulfing candlestick is, when you have a candlestick, a green candle that completely engulfs, the body of this candle will completely engulf the body of the previous and or multiple candles. In this case, we engulfed 1, 2, 3, 4, 5, 6, 7, 8, 9. That's a pretty big bullish engulfing candlestick. And those usually have, well, as the name implies, they are bullish, and they are potential bottoming sticks. Unfortunately, I've been throwing out a lot of caveats lately, and that's just the nature of this market. You've got to be a little bit skeptical of a final candle. You're seeing one here, but remember, the futures trade, they continue to trade after the market closes. This was the final closing candle of the day. It printed at 4 p.m. So you need to take that with a little bit of a grain of salt. However, it'll be either confirmed or not confirmed on Monday. I like to use bullish and bearish engulfing candles. Bearish engulfing candles come at a high. We don't have one here. I'm just looking to see if we had an example. They come after a prolonged uptrend, and they can mark a top. When you get those, it's just a big red candle that'll engulf the previous green candle or multiple candles. But I like to see a following confirming stick. So what that means on a bullish engulfing like this, forget about today. You know, the market's shut down in another hour or so for the day, for the weekend. It is. So you're going to have one more, a couple more little candles. Friday afternoon, evening candles, and then we shut down for the day. For the weekend, I'm sorry, really don't mean too much. So we'll kind of have to pick it up and see Monday. So what I'm saying is, yeah, I'm going to point out the significance of this. And should we gap up with a big, gap or a big move up on Monday or Sunday night, really, when the futures open, that would help to validate that and say we could get more upside. Otherwise, it could just be noise within the trend here. And if you notice here, you have a couple trend lines. We took out this one before the close and hit this one off the high. So we're really still below this very short-term trend since the highs on, what is that, Tuesday? No, there's Powell's pop on Tuesday. That was Wednesday, where we fell a little shy. And so you can see it doesn't take a skilled technician to see that the trend, the very near-term trend since then, is down. And there's still, you can draw a trend line to say it is still, a very near-term downtrend right now. And that's that. So that was ES. NQ, I showed you the same thing, I believe. There's the bullish engulfing candle, and back to what I was saying this morning when we started out here on that support, it had a little more downside to carry through, but again, at the same time, NQ was slightly cracking below 83.55 or so. ES had just made almost a perfect tag of its support, and so that really set the floor for NQ today. And you can see then a couple more tests into the close, and then that big green bullish engulfing candle. However, that doesn't, take out this very near-term downtrend either. So kind of micro stuff. I think it's important to point out, or at least I'd be remiss not to point it out, because it could carry through tomorrow. But I can also say this: the more powerful, more significant daily charts, we've had nothing but technical damage today. And if I could just probably sum up this video or what happened today in one word, it is bearish. If you are in that QQQ short trade, or you have any index shorts, you made money today. It's that simple. So I'm going through all this nitty gritty on the intraday charts, things that can lead, to more upside or more downside next week. But at the end of the day, we closed here down 1.69%. And so it's almost impossible to spin today as anything but bearish, particularly here on this longer term, daily chart, and the fact that Okay, sorry about that. I had a phone call there. Hate when I forget to turn the ringer off on the during the videos. So that's it. Again, we gapped down, and it was a big gap down. We closed the day down, and more importantly, we gapped down below this whole recent period of consolidation. So the battle today was won by the bears, but the war isn't over yet. The larger battle, if you will be decided if when these support levels below, which are the 200-day simple moving average, the 200, or that's the simple right there, the exponential right there, and then of course last Friday's low. But yeah, as of now, that's still looking like the most likely scenario. But again, as you've probably heard all day, I kind of threw out a lot of potentially conflicting analysis, things that and I'm going to get to those again in case you missed those earlier videos and front page posts. So that's it. And just once more to reiterate, I don't see any reason to modify the trading plan other than you might want to lower your stop on the QQQ short trade. We really ought to stay below entry now. Entry was give or take around, that's where it was when I screenshot it, 212.57, around there. And that's also, see, there's that gap from today. So you can look at that and say, even if we were to bounce on Monday, we do gap up, it's going to help to confirm that bullish candlestick. You got to keep that in mind. It could lead to more upside. But you have the gap from today, and you have quite a bit of resistance overhead. So sometimes the markets do this. They did it back in 2018 in December or October, I should say, in November, when we had initial leg down. We went in these choppy, here I'll show you, this choppy right here. Let me zoom into this level, and it gets tough, guys. It really does. It can it's not always so black and white on the technicals. So that's why I tend to talk during these videos. It's choppy kind of stuff, and that's why you sometimes, especially if you're just a trend or a swing trader, you just have to pick a side and stick with it. Or if you're not sure what to do, there's nothing wrong with being out of the market. The only thing worse than not making money on a move that you were expecting is to lose money because you're positioned wrong. So there's nothing wrong with sitting out and being in cash, especially if you're new to this, because a market like this, that was back in 2018, just like a market like this now will chew you up and spit you out if you don't know what you're doing, especially if you are prone to flip-flopping. Every time the market's up 2, 3, 4%, you get bullish thinking the worst is over. Every time it drops 2, 3, 4%, you're bearish and short again, but you're shorting after that drop, and then the market rallies up, and then you cover your shorts and you go long. Again, it's going to eat you to pieces. It's welcome to the world of volatility. So I'm kind of looking at the longer term charts, what's happened here, and I'm seeing pretty much nothing but bearish price action yet. Like I said, this bounced the last week and into earlier this week. That one started on Friday. So far, by my analysis, is nothing more than a run-of-the-mill counter trend bounce, oversold, kickback rally to resistance. All those levels I covered, including the 50% Fibonacci retracement, price resistance, and everything else. And this appears to be the start of the next leg down, with just a little more work to go. And I'll look and wait and see how. I'll probably wait to see what the futures do on Sunday night. And that way, if we are poised to gap down on Monday, I'll consider getting an email out, or I'm sorry, a post, an email in advance as to whether I think that we might overshoot that target and look for a deeper target, because that is certainly a possibility. I'm going to be studying the charts this weekend and see if there's more downside. And likewise, if we're poised to gap up quite a bit, I'll post an update. But again, as I just went over, just explained, it's going to take quite a bit to undo the bearish developments now. So I'm going to leave this suggested stop as is at 218.50, and I'll leave it up to each one of you whether you want to lower that down to at least break even or to assure a profit at this point. In fact, even above today's highs, we really shouldn't. If we pop much above today's highs, that's where we failed a couple times, then that could open the door for more upside there. I want to add that we don't have positive divergence on the 60-minute charts of QQQ or SPY, only the futures. The futures are going to tell you a different story with the indicators than SPY and QQQ, because the futures have a lot more candlesticks. They're trading virtually around the clock. You know, they shut down a brief period each day, and then they shut down over the weekend, but they pick back up Sunday night. And so you're going to have more candlesticks. Therefore, that's why I pointed out earlier that we have divergence here on the ES and NQ, but not on QQQ and SPY. If we had it on QQQ and SPY, I might take note a little bit more. So that's it. And let me show you one other thing. Okay, earlier I told you one of the things giving me pause on the market rally, and I did follow up. If you go through today's post, there was a couple, at least one question or comment in the comment section, and I replied about the VIX. And what I said, one thing about the VIX. Well, first of all, you know, my primary focus was the fact that the VIX is had hit the top of its multi-year trading range. There is no set ceiling, as I said in the earlier video. The VIX can go to whatever number it wants, but you know, historically it gets to a high end of a range just like it gets to a low end of the range, and that's usually about it. So it tends to be mostly range bound, but not by set parameters. You know, again, it can drop sometimes like this. This was an unprecedented drop. It had never in history gone this low. That was an unprecedented period of extreme low volatility right there, but then it snapped back and respected its longer term bottom of the trading range there, that support zone. And you can see going back here, this is 2015, early 2018, and now. And so what I said is pretty much, look, the VIX can go higher. Somebody inquired about that, but the risk reward is just not favorable. And one of the things too is the VIX can and often does drop like a rock. It doesn't stay at these levels very long. Once it gets there, it tends to drop quick. Somebody pointed out that, yeah, last time these were one and done tags, and this time we hit it and we went up again the other today above that other tag the other day. Yeah, it's something to note, but it's again, you're at that level. And if you look at the 60-minute chart, here's this is a bearish rising wedge pattern on the VIX. Pretty clear. Here's your uptrend line. There's your divergence right there, negative divergence. And the VIX today peaked right around the time of just after 3 p.m. when the market bottomed and hit that second successful test of those lows, those support levels that I highlighted earlier. And look at that, it fell 25% in the last hour of trading. So there's an example of, again, why you got to be very quick. Now maybe it's, you know, if you had the proper stop, it could have mitigated some of those losses, but as I told you, I started nibbling on that ultra short, or the short VIX. What was that security? Let me give you it, pull up that account, I have it in. SVXY, you know, and it had a nice move today since then. So, and I'm using that partially as a hedge to the shorts that I'm in. So, you know, if the market drops next week, then so be it. But I also pointed this out in one of those comment sections below, and we'll do it right here. Let's turn off all these. No, I got to go right here. Nope, where was it? I had it here. VIX and SPY. Here we go. All right, not sure. Let's turn all those trend lines off and okay, here's what I wanted to point out, and this is what I mentioned to one of the subscribers that asked about this. All right, so yeah, okay, here's those peaks right here in the VIX. This is their major tops back in 2015, early 2018, and right there in well, now here's where we're at now. So let's look at this. So the VIX peaked, and you had at the time a intermediate, you know, bottom and then a rally in the S&P 500. Sorry guys, the SPY is in blue right here, VIX is in gray. But what happened is the VIX topped, and look, the stock market continued to correct all the way into the lows in 2016 right there. And the next time, so we made a lower low in the S&P 500, but the VIX was much lower, and the VIX crashed. I mean, it came straight down on just a kickback rally and an ongoing correction with more to come. Right here, let's see, there's your peak in the S&P 500. VIX peaked right here, and guess what? The VIX fell, plunged, as a matter of fact, and the SPY kept falling until right here at this point. And you can see underneath the gray area, the VIX peaked much lower right here, right around the time the SPY peaked, and that was quite a bit later there. I can tell you in days if you want to know. That was from the day the VIX peaked, the The market continued lower for another 2 months right there, and from here, VIX topped around current levels. So volatility, maxed out, if you will, and the market didn't bottom for another 5.6 months. So what does that mean? How does that work? Well, people and institutions primarily have just gorged on put protection recently. That's what causes the VIX to spike. And so all that put protection, that's it. It's puts get very expensive. They were very cheap if you would have bought them down here, but they're so expensive now. So again, what's my point? Look, I can be right on the call the market has more downside, and also right on the call that the VIX may have just peaked, and that's evidence there. So like you said, the VIX can peak, and the stock market can continue to fall. And that might go against most people's conventional wisdom. If the stock market's falling, the VIX is going up. VIX already went up, and it went up a lot. So not to say that it can't go up anymore, but I just wanted to point that out for you guys. And I showed you, I think, some targets on that SVXY if you want to use it. You can also short TVIX or one of those, but pull back here. These are they were resistance levels, and that would be a support level. That'd be a minimum pullback target there, about 25.58. That's about a 52% drop in the VIX. So we got that. That's a pretty nice trade. And VIX is volatile. Don't take a huge position size, because if it goes against you, it's going to hurt you, and it can hurt you fast. But anyways, like I said, to me, it's I'm starting to nibble on that one, and depending on what happens next week, I may add to that position. And if nothing else, then it's still a hedge to my index shorts and the swing accounts. And then everything else I covered today, again, if you didn't have a chance to get those, we did have a quick trade breakdown on gold. This is GC Gold Futures. It snapped back in its wedge, but really didn't change anything with the technical posture. We still have this bearish rising wedge pattern, complete with divergence. In fact, the divergence is starting to steepen here, negative divergence. So should the market build on today's late stage rally, remember we did close down, but we put in those bullish engulfing candles. Washington comes out with some kind of gimmick to prop the markets up and stem the drop on over the weekend. It's possible. You can look at gold for a potential short trade. Otherwise, the trend in gold is bullish. Make no mistake about it. The trend in the market is bearish. And gold could break out and continue up above this level. But if not, here's the trend line to watch right here. This was called a whipsaw signal, even though there was a trade to be made, and we did hit that first target I had. That's something to watch again, that especially if the market bounces. It's a risk-off asset. The other risk-off assets are silver. Again, there was a trade to be made today. Pointed out this rising wedge pattern right here, 17 running into 1750 resistance. It broke down, hit that 1705 target, bounced up, and still below the wedge. So it's still in a near-term bullish trend, but a precarious technical posture, because 1750 is significant resistance. It's failed out a couple times recently, and it broke down below this wedge and remains below it. So we could be looking at more downside in silver. And here's the thing too, is if the market does drop next week, silver, gold is really of the precious metals the king of the risk-on assets or risk-off assets. Silver can drop and gold goes up, and even gold can drop in a big market drop. Why? Because you're going to get forced selling, liquidation. And we saw that a couple weeks ago in the drop, where gold was going down in line with the stock market, and I attribute that to forced margin call selling. So silver would be more prone to that, I think, than even gold. So there's something to watch there. And of course, if it can pop 1750 with conviction, you can see the next resistance level there. But you still have that divergence. You need to keep an eye on that. Last time we had that divergent high right here, it played out for a big drop. So that's silver. Treasury bonds, again, I'm just kind of recapping everything I went over earlier today, because those are the main things I'm watching. Ooh, looked like it started to crack. ZB has taken out that trend line that I pointed out earlier, and it did so. We also have a bearish high-level crossover on the PPO right here on ZB Treasury bonds. So I gave you guys targets earlier today when those levels broke. That was one of them. The first target, about a 2.5% drop down to 173, 159, plus this uptrend line right below. I think that's an excellent, what I call a high probability target. If we can get a little more, if the markets were to pop next week, go to the upside, and treasuries follow through on this breakdown. It came too late in the session to really risk taking it home over the weekend unless you're somewhat of a gambler. But should we get more downside over the weekend and into Monday, that I think is a very likely target. And then I gave you an additional target down here. Well, I gotta move this over, but that would be all the way down here, possibly to about this 165 216 level, and that would be about a 7+% drop in Treasury bonds. That would entail most likely a pretty good rally on the markets on Monday and into early next week for this scenario to play out. But it's again, I wouldn't be doing my job if I didn't point it out. And by the way, there's also a pretty good support level here along the way at about 169.022. You can see all my levels marked; they're pretty clear. Upside targets if the market melts down, I really don't have any. With treasuries being at highs here, new highs, you don't have any overhead resistance. So on this one, the risk reward, I would rather be short the markets than long treasuries, even though they typically trade inverse. I think the upside is getting very limited and stretched on treasury bonds for various reasons. So if the market drops, there might be upside. So in other words, I'm more prone to wait for the next shorting up on treasuries than I am to go long at these levels. And that's mostly it, guys. Back to these daily charts, they look pretty ugly. This is SPY. You can see this big wedge here on SPY, put in a big divergent high. I don't know where sometimes these lines just seem to disappear, but you can see the divergence is there drawn with this. There's your negative divergence right there. There's your divergent high on SPY, and divergence coming up there, divergence that way. Breakdown, and just nothing but impulsive selling and a little consolidation here in this range. So again, kind of the bigger picture, if you just take a step back, is this range here. If we break to the downside, obviously that's not going to be bullish. And we're also, you can see on SPY, we're well below the 200-day SMA and the 200-day EMA. Those are key moving averages. They've contained pullbacks for quite a while in the market, but when you drop below them, that's a warning sign. You kick back to them. Sometimes you overshoot a little, but support, once broken, acts as resistance. And these are pretty good trend indicators. They're very simple, effective, and a lot of traders, both retail traders and institutional traders, will look at these levels. So the S&P 500 is in a very precarious technical posture. It's in a bearish technical posture outright. QQQ is in a precarious technical posture, dancing right above its similar moving averages there. And again, if I could only, well, I am. I'm short in my swing counts. I'm going to go home short over the weekend. And active trading account, I will just manage that depending on what we see in the future starting Sunday night. But swing position, I'm still favoring more downside here in the markets. And if anything changes on Monday or Sunday night even, I'll let you guys know. All right. Wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great weekend.